I talk about index fund investing a lot on this channel. It has been my favorite way to invest for years because of one simple reason. It just works for basically everyone. Oh, and they're simple to invest in and extremely cheap and outperform most active investors and are pretty much dummy proof. Sounds a little bit too good to be true, right? Except it's not. But it turns out a lot of people don't understand them. I've been getting a ton of questions about what an index fund is, how they work, and many other questions. So in this video, I'm gonna go through everything you need to know about index fund investing. By the end of this video, you'll really understand why they're one of the best investments that you can put your money into. I personally prefer using Vanguard index funds, so that's what I'm going to be using for all of my examples throughout this video. Now, there's a ton of other ones that are out there that are just as good, so feel free to use those ones if you'd like. No, this video is not sponsored by Vanguard. I just love them that much to the point where if Vanguard was a woman, I would marry her in a heartbeat. Hey, I'm Jarrad with an A, and on this channel we talk about all things personal finance, investing, and we try to have a little bit of fun in the process. Quick disclaimer, nothing I say should be taken as financial advice. Do your own research before investing your money instead of listening to a random guy like me on the internet. An index fund is a way for you to invest in hundreds or even thousands of companies by purchasing one share of that index fund. It would be like you and me going to a horse racing track where there's 3,000 horses racing at the exact same time. Now, each horse in this race would represent one publicly traded company on the stock market. Each of those 3,000 horses is vastly different and will perform very differently during the race based on everything that went into the training of that horse leading up to the race. They've each been on different diets, they've trained completely differently, they've trained in different climates, they're on different performance supplements, some are rookies, some are veterans, some have been winners in the past, some have been losers in the past, and the list goes on for what makes them different. Now, you and I want to bet some money so that we can go home winners. Being able to brag to all of our friends that we won money is very important, but we need to make sure that we pick the right horse. The top 1,000 horses who cross the finish line will win you money. First place will win you the most money, second place a little less than that, third place a little less than that, and so on. The horse that finishes in place 1,000 will still win money, but very little. Instead of trying to guess which horses will finish in the top 1,000 by betting your money on a couple of different horses, you decide to place a bet on every single horse in the race. Now, this is going to increase your chances of leaving the racetrack with money in your pocket. This is essentially what you're doing when you invest in an index fund. It's a way for you to own a piece of hundreds or thousands of stock within a specific index fund by purchasing one share. Yes, you're going to be placing a bet on some losers within the group, but the money you win from placing your bets on the winning horses will outweigh the money lost on those losing horses. It's like saying, instead of trying to find the needle in a haystack, why not just buy the whole haystack and be done with it? Do me a huge favor and Hulk smash that thumbs up button if you're enjoying this free content that I put together just for you. It really helps support myself and this channel. But we have to keep in mind that just deciding that you're going to invest in an index fund is only the beginning of your decision to become this type of investor. Each index fund out there has a different goal, and the goal of that index fund will determine which type of investments are held within it. For example, if you want to invest in real estate, then there's real estate index funds out there like VNQ that holds 180 different stocks for the price of $73. If you want to invest in international stocks, then Vanguard offers a total international index fund that spreads your money among 7,000 different stocks for the low price of $45. They even take it one step further and offer a total world index fund which holds 8,000 stocks from all over this round earth that we live on. Wait, I mean flat earth. No, I mean round earth. Okay, now I'm confused. There's even bond index funds as well, like BND, which holds a bunch of different bonds. If you're from the United States and you want to keep it in the family, then there's the Vanguard S&P 500, which holds stocks of the 500 largest companies in the United States. Think companies like Microsoft, Amazon, Apple, Facebook, Johnson & Johnson, and Visa. And we of course can't forget my personal favorite. It holds a special place in my heart, which is the Vanguard Total Total Stock Market Index Fund, which holds over 3,500 different stocks that range from large, mid, and small cap companies. One thing to keep in mind is that most of these index funds are fully invested in stocks. If you're someone who wants to have a certain percentage of your portfolio in bonds as well, then you'll have to add that separately. For example, you might really like VTI, the Vanguard Total Stock Market Index Fund, but you also want to have some exposure to bonds as well. Because of this, you might have 80% in VTI and 20% in BND. If you are someone who also wants to have a little exposure to international funds as well, then you might choose to invest based on the 3-fund portfolio strategy. This is where you only hold 3 index funds that spread your risk across United States companies, international companies, and bonds as well. An example of a 3-fund portfolio might look like 70% in VTI, 20% in VXUS, and 10% in BND. This is just an example and should not be considered investment advice by any means. The way that you invest in an index fund is by first choosing which investing platform you want to use. There's a ton of good ones out there for you to pick from. To help you out with this, in the description, I'll link a video that I made on the top 5 investing platforms out there. I personally prefer using M1 Finance for the majority of my investing since they fit my buy and hold passive investing style. I'll have a link to check them out in the description of this video. If you do use that link, then it does help support this channel and me at no extra cost to you. No pressure though. After you pick an investing platform, then you'll need to choose the type of investment account that you'd like to start investing into. Is this going to be an IRA, 401k, 403b, or taxable investment account? I made a whole video to help you out with this as well, which I'll link in the description of the video and somewhere above my head. Some people might say that index fund investing isn't for everyone, but in my opinion, and based on countless financial studies out there, some sort of index fund should be a part of 99% of people's investment portfolios. One of the biggest advantages of investing in index funds is the fact that they're extremely easy to invest in and manage. You don't have to worry about doing research on each individual company publicly traded on the stock market to determine which ones you should buy or how many shares you should buy as well. The percentage of a company held within an index fund is already predetermined for you. All you do is deposit your money into your brokerage account, purchase how many shares you want, and the busy work of buying each individual company is all handled for you. This is such a big selling point for the average person out there who wants their money to grow, but isn't big into spending their time nerding out on the individual stocks to purchase. I'm someone who is absolutely obsessed with money, personal finance, and investing. I would talk about this stuff for hours and hours, and I kind of do, mainly to myself more often than not, but I have zero interest in going through the whole dog and pony show of digging into the balance sheets of every company that I want to put money into. Even though I know how to evaluate a stock before buying it, I still don't trust that I'll be able to set my natural human emotions aside for long enough to make a smart purchase. And believe it or not, my returns will most likely be higher since I've opted to leave the stock picking process up to my index funds. That's because index funds are extremely effective when it comes to the returns that you would expect. To determine if they're effective or not, you'd need to look at what your returns would be if you had invested in something else like picking individual stocks on your own or investing in an actively managed mutual fund. Just so we're on the same page, an actively managed mutual fund would be a fund that holds a bunch of different stocks, kind of like an index fund. The biggest difference between an index fund and a mutual fund is that the mutual fund has a fund manager that is actively picking which stocks to buy, which stocks to sell, how often they do this, and how much they're spending on each stock. An index fund also has a fund manager, of course, but his or her role is a lot more hands-off. It's not up to that fund manager as to which stocks to buy, sell, and how often to do these two things. These decisions are already determined based on the particular index that index fund tracks. For example, an index fund like VOO tracks the S&P 500. Therefore, it's only going to hold the exact same 500 companies that the S&P 500 holds. If we look at the returns from an actively managed mutual fund, their track record isn't very good when compared to an index fund. Believe it or not, the returns actually get even worse as time goes on. Based on a report from last year, 64% of actively managed funds underperformed an S&P 500 index after just 1 year. After 10 years, that number shot up to 85%, And after 15 years, 91% of them didn't outperform a standard S&P 500 index. That means that if you're a long-term investor and you decided to put your money into an actively managed mutual fund, then there'd be a less than 10% chance you'd pick the fund that would actually outperform an S&P 500 index. You'd have better odds at a higher return if you went to a roulette table in Vegas and put all of your money on black. At least that way, you'd have a 47.4% chance of doubling your money. By the way, don't do this. Please, don't do this. The success rate of those mutual funds is actually worse than what I showed you due to something called survivorship bias. The reason for that is because as time goes on, if a mutual fund has such horrible returns, then they just close the fund down, and those mutual funds that have been shut down aren't counted in the numbers. So you should technically expect that the 9% success rate is a lot lower. One of the reasons an index fund can outperform an actively managed mutual fund is because an index fund is very cheap to own. It would be like you paying less money for a better quality product. The more money you're charged in fees, the more those fees eat away at your returns over time. Index funds are known for having the lowest fees out there, aka expense ratios. The Vanguard Total Stock Market Index Fund, VTI, only charges 0.03%, which is one of the lowest out there. If we look at an actively managed mutual fund like this one from American Funds, then you can see not only the insane expense ratios you're charged, but also the other fees that you're charged as well. A 1% yearly fee might not seem like a lot on the surface, but if we look at how much it costs you over time, it kind of makes you sick to your stomach. If you're charged a 1% fee and you invested $10,000 per year, then after 40 years of investing, you'd have paid over $500,000 in fees, and your returns would have been a lot lower. You could have bought 7 Tesla Model S's and still had $30,000 left over to travel the world if you instead decided to invest your money into a low-cost index fund that only charged you 0.03% like VTI. Index funds are known for being cheaper to own because they're able to keep the cost of running it very low. Since the goal of which investments to hold is already predetermined, then you don't need to pay a whole bunch of analysts and other people to manage that fund. This cost savings is passed on to you, the investor. Over the past 2 years, we've seen Vanguard lowering the expense ratios of all of their index funds whenever they can. I've seen VTI go from 0.05% expense ratio in 2017 to 0.03 in 2020. Probably my favorite part about index fund investing is that it is insanely easy and very difficult to screw up. Once you pick which index funds you want to invest in and the percentage of money you want to go towards each one, there's nothing more that you need to do except start putting money into your account to be invested. Yes, you want to log in at least twice per year to check up on things, but other than that, the process should be pretty automated. For beginner investors or anyone who doesn't feel comfortable investing yet, I always tell them to just put their money into an index fund while they learn more. The longer you're sitting on cash that's not invested, the more money that you're losing from not having that money in the market working for you. You're always better off getting your money invested as soon as possible as opposed to waiting until you know everything there is to know about investing in general. And index funds are a great way to do that. You'll have a higher likelihood of regretting picking individual stocks than you will investing in an index fund. Watch this top video next where I show you my personal investment portfolio, or the bottom one where I show you the roadmap for how you should invest your money. Check out the description for more resources and playlists to help you out with all of your personal finance and investing needs. Make sure to Hulk smash that thumbs up button. I'll see you in the next one, friends. Adios.